Yeah, ladies and gentlemen, I would rather say the headline should be the return on inflation of inflation not here to stay. Ladies and gentlemen, what do you expect when a board member of the Deutsche Bundesbank talks about inflation? You probably expect a firm view. We will see later if I really can deliver on those expectations, but this is just the easy part. When it comes to expected policy outcomes or expected path of prices for financial assets, things get a little bit more complicated. Take a look at the market for derivatives like future swaps or options. They can indicate that the distribution of plausible outcomes in markets has widened substantially of late. Implied volatility in bond markets has spiked higher. We call this uncertainty. You will probably agree that the recent events are not making our jobs, either yours or mine, any easier. The collapse of Silicon Valley Bank and worries about Credit Suisse have sent ripples through financial markets. Government bonds and bank debt went on a roller coaster ride after stress in parts of the US banking system triggered bouts of safe haven flows. Yes, volatility has been high, market liquidity has suffered, but overall, financial markets have continued to function. First, intermediation in unsecured and secured money markets has continued to work quite well. Second, in governmental bond markets, there have been no signs of fragmentation in the euro area. And third, the euro has been rather robust in currency markets. What is more, bank equity and debt have recovered some ground over the course of this week. Now let me add a few remarks on the euro area banking sector. I think we can all agree that the industry is in much better position than 10 or 15 years ago. Banks' capitalization is much higher and stronger. Their liquidity position is also much stronger. It is fair to say that the euro area banking sector is resilient and its regulatory framework is sound. This also includes a solid resolution framework to deal with situations where shareholders and creditors of a troubled bank have to bear losses. On this matter, I really would like to reiterate what the ECB, the SRB, and the EBA have already pointed out earlier this week. In particular, common equity instruments are first in line to absorb any losses that occur. Only after they have been fully used up would additional Tier 1 AT1 instruments be required to written down. This approach has been consistently applied in past cases and will continue to guide the action of the SRB and ECB banking supervision in crisis intervention. Additional Tier 1, a market of roughly 250 billion euro, is an important component of capital structure of European banks. Lastly, on the market environment, recall what ECB Governing Council emphasized just 1 week ago. The Eurosystem's toolkit is fully equipped to provide liquidity support if needed and to preserve a smooth transmission of monetary policy. And most of you will know in this context, you will have seen that the Euro system has increased its frequency of providing 7-day US dollar funding from weekly to daily of this week. And and this facility, which is backstop priced, is designed to enhance the provision of liquidity via the standing US dollar swap line arrangement between 6 major central banks. The take-up of this facility has been very limited, which is, of course, very good news, as banks can readily meet US funding needs in the market. So let's talk about now the actual topic of my speech, inflation. Almost 9%, Germany's headline inflation last year was one of the highest since the foundation of the Federal Republic. February's rate of 9.3%, while lower than in the month before, is still far too high. In particular, the recent increase in core inflation that excludes volatile energy and food prices is a concern. Importantly, both headline inflation and core inflation in Germany will probably remain above the 2% mark next year and probably in 2025 too. And the same holds true for the euro area, where ECB staff projections see core inflation rates averaging 2.5 and 2.2% in 24 and 25, respectively. Against the backdrop of high inflation, the ECB's Governing Council has pursued the fastest rate hiking cycle in the euro area's history. In less than a year, it has raised interest rates by a staggering 350 basis points. And this underscores the determination of the euro system to fight inflation. And as Christine Lagarde said at last week's ECB press conference, inflation is projected to remain too high for too long. Ladies and gentlemen, we all know that the effect of monetary policy show up with time lag. This means that it takes some time before the economy fully digests and incorporates policy changes. And recent financial market volatility has added, unfortunately, another layer of uncertainty. All this underlines the importance of data-dependent approach of the Governing Council's policy rate decisions. And 3 components or determinants are key here. First, the assessment of inflation outlook based on incoming economic and financial data. Second, the dynamics of underlying inflation. And third, the strength of monetary policy transmission. On this third point, I think this is very important. We are beginning to see the transmission of monetary policy measures through the credit channels. It remains to be seen if and to what extent the recent tensions in part of the banking sector will lead to a further tightening of financing conditions. But to be clear, the underlying price pressure in Germany and in the euro area remain high. If monetary policy fails to tame them, the cost to our economies would be much higher. Thus, it is the responsibility of the euro system to ensure a timely return of inflation to 2% medium-term target. Let's also talk about the scaling back of the asset purchase program. March also marks the starting point for shrinking the size of Eurosystem Asset Purchase Program, or in short, APP. In concrete terms, this means that the central banks of the Eurosystem will reduce their bond holdings by not replacing 50 billion euro of maturing securities each month. Well, from a marketing functioning perspective, there are good reasons for taking such a rather measured approach. First, the ease of absorption of higher bond volumes hinges on how market participants evaluate the outlook for inflation and the expected rate path, amongst other things. Second, having suffered substantial mark-to-market losses in their fixed income portfolios last year, investors remain vigilant about interest rate risk weighing on the valuation of their portfolios. And third, a large share of this year's elevated bond issuance will most likely hit the market in the first half of this year. And also, let me be very honest, it's my very last point on that, central banks have little experience with the process of balance sheets tightening. Certainly, the process of quantitative tightening will not simply be the mirror image of quantitative easing. Importantly, markets reacted calmly to the Eurosystem gradual withdrawal in early March. Various market contexts, as well as also the incoming data, confirm that higher yields and coupons for fixed income assets are creating incentives and opportunities. That is in case not only for price-sensitive investors, but also for structural buyers such as insurers or pension funds. Many institutional investors who expanded the illiquid parts of their portfolios over recent years are regaining their appetite for fixed income assets. So let's talk about the last point, what I think is pretty important if you talk about inflation. And you will have a panel after this. Maybe they can pick up this. We should talk about potential structurally higher inflation. In the short term, the policy focus is on bringing down cyclical inflation, largely deriving from the poly crisis of the past 3 years. However, there is another twist in the current challenge which most of you already be aware of, and I only will briefly touch upon today. Namely, the question, is the era of structurally low inflation pressure coming to an end? After 2 decades of subdued price pressure, the tide may well have turned. Looking forward ahead, changes in underlying trends could intensify inflationary pressures. Some people refer to these challenges as the 3 Ds. And let me start with the first D. That's the D for deglobalization. Driven by geopolitical tension and a desire to reduce economic dependencies. Related processes have or become known as friendshoring or nearshoring. The second D stands for decarbonization of economy. Incentivized in particular through carbon pricing, could exert persistent upward pressure and not just on energy prices. The third and the last D is demographics. More precisely, the assumption that dwindling labor supply will continue to exert upward pressure on wages. All these factors could turn out to be inflationary over the coming years. And that's another reason why the Eurosystem must remain vigilant in this regard, ensure that the inflation expectations remain well anchored around 2%. Ladies and gentlemen, let me end with a quote. Geeta Gopinath, the IMF's first deputy managing director, has summed up the tasks of central bankers neatly. Monetary policy should remain data-dependent, be well communicated, and ensure that inflation expectations remain anchored. I couldn't agree more. And having a compass of that kind is all the more important in times of elevated uncertainty. This way, we can be confident that the euro system will restore price stability in the euro area. Thank you so much.